Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Columbus Mckinnon Corporation quarterly report. Columbus Mckinnon Corporation offers a wide range of products and services to various industries worldwide. The company's product portfolio includes motion solutions such as manual and electric chain hoists, wire rope hoists, winches, lever tools, and air-powered hoists. They also provide high-precision conveying systems, power control and delivery systems, and digital motion control systems for underground coal mining equipment. In addition to these products, Columbus Mckinnon Corporation designs and manufactures industrial components such as mechanical and electromechanical actuators and rotary unions. The company also offers crane components and crane kits, aluminum light rail workstations, and elevator application-specific drive products. Furthermore, they provide a variety of securing devices including load binders, logging tools, hooks, shackles, hammer locks, and master links. The company serves various markets including EV production, aerospace, energy and utilities, process industries, industrial automation, construction and infrastructure, food and beverage, entertainment, life sciences, consumer packaged goods, e-commerce, supply chain, and warehousing. Their products are sold to end users directly as well as through industrial distributors, material handling specialists, integrators, service after-sale distributors, original equipment manufacturers, government agencies, and engineering procurement and construction firms. Overall, Columbus Mckinnon Corporation is a leading provider of motion solutions and industrial components to various industries worldwide. Columbus Mckinnon Corp's stock price has increased significantly over the past year, with an 11.29% rise in value. This growth can be attributed to several key news events and strong financial performance. The acquisition of Keto Crosby Limited was a major driver of this increase. The announcement of the acquisition agreement on February 10, 2025, set the stage for Columbus Mckinnon's transformational period. Regulatory clearance from the U.S. Department of Justice's Antitrust Division on January 31, 2026, removed a significant hurdle for the completion of the deal. The company officially completed the acquisition on February 4, 2026. The strategic move is expected to expand Columbus Mckinnon's offerings and scale, aiming to establish it as a global leader in intelligent motion solutions. The company anticipates delivering $70 million in annual run-rate cost synergies and an improved adjusted EBITDA margin from the combined entity. In addition to the acquisition, Columbus Mckinnon reported strong financial results for its fiscal year 2026 third quarter, which ended December 31, 2025. The company announced double-digit sales, order, and EPS growth, surpassing analyst expectations. Revenue for the quarter came in at $258.7 million, exceeding the consensus estimate, and adjusted earnings per share were $0.62, beating analyst estimates by $0.04. These factors have contributed to Columbus Mckinnon's stock price increase of 54.69% over the past 6 months, and a 49.09% rise in the last 3 months as of early February 2026. Columbus Mckinnon Corporation market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Columbus Mckinnon Corporation trades at a higher price-to-earnings ratio of 176 times, and a lower price-to-book ratio of 0.71 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On one hand, several factors have contributed to revenue growth. Industrial economic and general macroeconomic conditions have positively impacted revenue, as has the Kito Crosby acquisition, which was valued at $2.7 billion. Sales incentives, such as volume-based discounts and rebates for priority customers, have also driven revenue growth. Additionally, custom-engineered products contracts with enforceable right to payment have contributed significantly to revenue. Furthermore, standard product sales and installment payments for custom-engineered contracts have also played a role in driving revenue growth. The company's ability to increase prices has resulted in an additional $6 million in revenue, while foreign currency translation has added another $7 million. On the other hand, several factors have led to revenue decline. The divestiture of U.S. power chain hoist and chain manufacturing operations is expected to have no material adverse effect on the company's financial position, but relocation costs for North American linear motion operations and precision conveyance factories have resulted in a decrease in revenue. In terms of product grouping, industrial products and crane solutions have seen significant growth, while engineered products have also experienced an increase. However, precision conveyor products and all other categories have declined in revenue. Overall, the company's revenue growth can be attributed to a combination of industrial economic conditions, strategic acquisitions, sales incentives, and price increases, while revenue decline is largely due to relocation costs and divestiture. Net income for the company saw a significant increase in both the 3 months and 9 months periods ended December 31, 2025. Compared to the same period in 2024, net income rose by $2,038 in the 3-month period and $11,149 in the 9-month period. However, profit margins experienced a decline. The gross profit margin decreased by 0.4% in the 3 months ended December 31, 2025, and by 0.2% in the 9 months ended December 31, 2025. Operating profit margins also saw a decrease of 1.3% in the 3-month period and 2.4% in the 9-month period. The reasons behind these changes are multifaceted. On one hand, revenue from standard products increased due to sales incentives and volume-based discounts. This contributed positively to net income. On the other hand, raw material costs and tariffs had a negative impact on profit margins, but prices were raised to customers to cover these increased costs. The integration of Kito Crosby also introduced uncertainty, with potential delays or changed circumstances affecting financial health. Furthermore, substantial indebtedness following the acquisition has had adverse effects on the company's overall financial well-being. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has achieved a net inflow of cash from operating activities, totaling $20,595 in 2025. This positive trend suggests that the company is successfully managing its day-to-day expenses and generating sufficient revenue to cover them, resulting in a surplus of cash. This achievement is a testament to the company's operational efficiency and financial management. The ability to generate positive operating cash flow is crucial for any business, as it enables the company to invest in growth initiatives, pay off debts, and reward shareholders. With this trend continuing into 2025, investors can expect the company to maintain its financial stability and potentially even increase its market value. The company's debt level has undergone some changes in recent years. While the current portion of long-term debt and finance lease obligations has decreased slightly from $50,739 in 2023 to $50,829 in 2025, the term loan, AR securitization facility, and finance lease obligations have actually decreased more significantly from $420,236 in 2023 to $399,439 in 2025. However, it's worth noting that non-current liabilities have increased from -$5,225 in 2024 to -$8,875 in 2025. In terms of interest expenses, the company has seen an increase from $22,511 in 2024 to $23,977 in 2025, indicating a rise in debt-related costs. The 3 and 9 months ended December 31, 2025 also show higher interest expenses compared to the same periods in 2024. Overall, while there have been some fluctuations in the company's debt level, the increase in interest expenses suggests that the company is still carrying significant debt and incurring substantial interest costs. Management is optimistic about the company's outlook, expecting significant growth in sales over the next 2 years. The company aims to recognize $11.3 million in sales within the next 12 months and $28.1 million over the following 24 months. To achieve this goal, management plans to adopt a market-led, customer-centric approach that will enhance shareholder value by expanding EBITDA margins and ROIC. The acquisition of Keto Crosby is expected to have a positive impact on the company's scale, geographic reach, and core lifting business. However, there are potential risks associated with the integration process, including disruptions and underperformance of the acquired business. Management has committed $12 million to $16 million in capital expenditures for fiscal 2026 to support new product development and improve productivity. Management is confident that the company will have sufficient funds to cover operations and debt obligations for at least 12 months. They plan to meet funding needs through cash from U.S. operations and repatriating non-U.S. cash without significant incremental taxes. Overall, management's strategy focuses on expanding the business system, improving operational efficiency, and enhancing shareholder value through strategic investments and acquisitions. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has expanded its portfolio by purchasing Keto Crosby acquisition, Montradec GmbH, Dorner MFG Corp., and Garvey Corporation. These acquisitions are expected to enhance the company's capabilities and offerings. On the other hand, the company has also engaged in divestitures, which involve selling off certain business units or assets. One notable example is the planned divestiture of a business unit, subject to customary closing conditions being met. This move suggests that the company is streamlining its operations and focusing on core areas of growth. The company has a history of rewarding its shareholders through various means. One way they have done this is by paying dividends. The financial records show that the company declared dividends per common share for both 2024 and 2025, indicating a commitment to sharing profits with investors. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. According to the records, the company purchased treasury stock in significant amounts, including -143,734 shares in 1 year and -148,916 shares in another. This demonstrates a proactive approach to managing shareholder wealth and maximizing returns on investment. There are concerns about inventory buildup or supply chain disruption in the company's operations. One of the main concerns is inventory obsolescence, with a significant amount of inventory valued at $3,567,000 in December 2024 and $2,115,000 in March 2025. This suggests that the company may be holding onto outdated or unsold products, which can lead to waste and financial losses. Furthermore, the carrying amounts of inventory as of December 31, 2025 are approximately $10,673,000, indicating a substantial amount of inventory being held by the company. This could be a sign of inefficient supply chain management or overproduction, leading to potential disruptions in the future. Additionally, the relocation of manufacturing facilities and consolidation of operations may indicate supply chain disruptions, as these changes can lead to delays and inefficiencies in production and delivery. The higher raw material costs due to global inflation and tariffs are also a concern, as they can increase the cost of goods sold and reduce profit margins. Finally, availability issues for select raw materials and components pose another risk to the company's supply chain. These shortages can disrupt production and lead to delays or even cancellations of orders, further exacerbating inventory buildup and potential disruptions in the future. That concludes the financial summary for Columbus Mckinnon Corporation. Feel free to comment below, and I will be happy to answer them when possible.